Nikki, I have a limited company. How should I pay myself?
Okay, so there's quite a few different ways that you can take money out of the business for yourself. Uh, the mix of how you will do that will depend on your and your business's personal circumstances. However, I'll just go through sort of some general rules. So firstly, a salary. If you have a salary from the business, at least making sure that you're utilizing your personal allowance. Any salary that you receive will be deducted for corporation tax from the company. So when you're taking into account how much you're taking, you can offset the fact that the company is receiving corporation tax relief for that salary. The amount that you might actually want to receive in salary will depend on various factors. It will depend if your company is profitable. It will depend if there are other shareholders in the company. It will depend on what the market rate for your salary is. And it may also depend upon how much you want to take, depending on what other forms of income you may have. Secondly, you may be thinking dividends. I'm actually going to say expenses. Anything that you have incurred for the company that's wholly exclusively for the company and therefore is reimbursable, make sure that you claim that, because that is tax-free money to yourself. If you are paying for coffees for clients and things like that, you may think, oh, I'm not going to claim them because perhaps they're not allowable for corporation tax for entertainment. Because they're entertainment. However, the point is, are they tax-free to you? So I would also always make sure that you claim all the reimbursable expenses that you have incurred and make sure that money gets back into your pocket. Thirdly, if your company is profitable, you may wish to consider issuing dividends. Now, this will be up to the board to decide. So it will depend upon the position of the company. It will depend upon the cash flow and depend whether the board wants to declare dividends or not. So that one, obviously, if you are the sole director, therefore you are the board, you have lots of control over that. However, if you're in a mixture of other people in there, then that is a different scenario. So, but they are generally, if you compare salaries to dividends, generally for personal tax purposes at the moment, they are generally slightly more tax efficient having dividends than salary, because at the moment there's no national insurance associated with dividends. However, dividends, just caution, dividends are supposed to be payment for the investment of your capital in the business. They shouldn't be just considered a replacement for salary. Then fourthly is pension contributions. So it's really important to make sure that you do, wherever you can, utilise your pension allowances. And it's a very tax efficient way to save up money by putting money in pensions. So it may be a mixture of employee and employer contributions, or you may be looking at just 100% employer contribution under salary sacrifice. Again, it will depend what else you've got in your pension pot and what other contributions you've got happening. However, generally it's a very tax efficient way. If you're doing it as an employer contribution, your company is also receiving corporation tax relief on those contributions. So it's a pretty efficient way. And if you think about it, say you're 50, you can potentially access that personal pension in 5 years' time. Why not, if you don't need the cash now, why not put more of your salary into that pension? Because you won't be getting income tax on it. It can nicely build up and increase your pension value. I, of course, can't advise on which pensions are right. I'm not an investment advisor, but from a tax perspective, pensions are very tax efficient.